Hello, hi. Good evening, friends. I am Abir. I am an attorney uh, of LNL Partners, and I look after banking, finance, and insolvency restructuring practice. With me, my colleague Arshi is also going to be here, and she would be presenting few of the slides. Uh, before we would get into the main presentation, I would quickly tell you about our firm profile. I am representing Luthra and Luthra, now LNL Partners, and we are a full service law firm. And we we deal with banking, finance, merger, acquisition, private equity, and various other sector of law, and including litigation. Arshi, if you can please brief yourself.
Hi, I am Arshi Siddiqui. I am a law student. I'm pursuing law from Government Law College, Mumbai. I'm currently in my fourth year. I'm an intern at Luthra and Luthra, and I assist the banking and finance team there. And today I'll be assisting Mr. Abir on this webinar on the topic COVID-19 response on banking and finance, measures and reliefs.
Thank you, Arshi. Now, all of you would be thinking that why this topic and why not day-to-day thing, day-to-day problems are there. There are a lot of ministry notification, red zone, orange zone, green zone, everything is coming up. Now, the topic why it is important is while we all are busy fighting COVID in our day-to-day life, our banking channels are working day night to ensure that the public as well as financial markets are up and running and they are able to meet the requirement of the whole country. Banking system itself is a backbone of any country, and its failure could lead into multiple issues for a country like us. Any prudent banking system armed with the proper regulation and safeguard would attract multiple investment, improve lives of the people, and put country in a higher pedestal. Now, Arshi, if you can go to the outline of the presentation, please. Yeah. So this is the outline of the presentation. Basically, we are going to deal with what all Indian authorities and nodal agencies have done so far in terms of taking measures and giving relief due to COVID and post-COVID situation. Now, what we are going to do, we are going to, at the end of each slide, or maybe at the end of each chapter, we are going to request all of our viewers to ask questions, and we would try and respond to those questions to the extent possible, because we would like this to be interactive, because you would be having a lot of questions, I'm assuming, and we would be happy to provide to the extent possible, though we understand the timeline timelines and short timelines, and we may have to go to our uh, daily things as well. Now, with this, I will just simply tell you that the presentation is divided into 5 chapters. First is the important one is measures taken by RBI. Second, the measures taken by SEBI. Third, the measures taken by Insolvency Bankruptcy Board of India as well as MCA. Fourthly, it is the FDI regulation change, which you've been reading on newspaper and various media channels as well as the rules and regulations came in lately with respect to FEMA amendments. And lastly, the important topic is then how our banking, finance, and lending transactions have been impacted due to COVID. Now, while on RBI is the Central Bank of India. This is for the people who are not from India. I'm just going to give a quick snapshot about RBI and SEBI and other nodal agencies, so it would be easier for them that how come RBI suddenly came into picture and they have given, and they have issued notifications and various directives. So it is the Central Bank of India, which was established on April 1, 1935. That was during British era. under the Reserve Bank of India Act. RBI uses its monetary policy to create financial stability in India, and it is also charged with regulating the country's currency and credit system. Next slide, please. Arshi, next slide, please.
Yeah, I am on the next slide.
Okay, thank you. Now, RBI came up with multiple measures, and it would be interesting to note that before lockdown took into place, which is on March 24, 2020, on March 16, 2020, RBI came up with some measures, and they have indicated to all scheduled commercial bank, excluding RRB, local area banks, small finance bank, and all payment banks and urban cooperative and NBFCs, almost every entity within the financial sphere, to devise strategy and monitoring mechanism concerning the spread of disease within the organization, taking stock of critical processes and revisiting the business continuity plan in the emerging situation scenarios with the aim of continuity in critical interfaces and preventing any disruption of services, taking steps of sharing important instruction and strategy with the staff member at all levels, and encourage their customer to use digital banking facilities as far as possible. Now, this is very important for all of you to note that RBI on 16th requested all banking channels, all banking entities, that they should encourage all general public to use digital banking facilities as far as possible. Now, what you would have seen in India that most of the people are not tech savvy, though we have reach of mobile phone as well as internet today, but most of the banking work still being done at banks. And now, with the emergence of COVID, we feel that the fintech sector is going to emerge most likely. Fintech sector is already in India. There are regulations there, but in going forward in future, fintech sector is going to come up in a very big way. As you would recollect that there has been a sort of tie-up between Facebook and Geo, and this is one of the indication that now Indian economy as well as Indian people would slowly be moving into digital space. Now, going into the next circular, subsequent to March 16th, March 24 lockdown happened, and immediately on March 27, 2020, RBI came up with statement on development and regulatory policies. Now, in their statement, they sets out various development and regulatory policies that directly address the stress in the financial conditions caused by COVID-19. Couple of them I would quickly tell the audience is expanding the liquidity in the systems feasibly to ensure that financial market and institutions are able to function normally in the face of COVID related dislocations, reinforcing the monetary transmission so that the bank credit flows on easier terms are sustained to those who have been affected by the pandemic, because you would recollect and you would see that there are a lot of companies, there are a lot of other people are badly, hugely impacted by this COVID issue. Thirdly, easing financial stress caused by COVID-19 disruption by relaxing repayment pressure and improving access to working capital. And one of the last measures is improving the functioning of market in view of high volatility experience with the onset and spread of pandemic. So these were the reason RBI came up with statement of development and regulatory policies on 27, and immediately after declaration of these policies, the RBI governor and RBI came up with various notifications subsequent to this declaration of policies. Now, if you see the policy was divided into three things, which is very important to note. One is liquidity management, second is regulation and supervision, and third is financial market. We are going to take you through all three measures taken by RBI, and we'll try and make it very simplified for you, as well as we will try and explain you why these measures were came into effect from a general public perspective without getting into a lot of complex sort of discussion and getting into the nitty gritties of it. Now, in under the liquidity management, there were a couple of measures were taken like TLTRO, cash reserve ratio, marginal standing facility, widening of monetary policy rate corridor. Uh, Under the regulatory and supervision measures, there were moratorium on term loans, deferment on interest on working capital facility, easing of working capital financing, deferment of implementation of net stable funding ratio, and lastly, deferment of last tranche of capital conservation buffer. Lastly, the financial market, RBI permitted banks to deal with offshore non-deliverable rupee derivative markets. Now, let us go through each of these measures taken by RBI in detail. So, first one is targeted long-term repo operations, which is called TLTROs, which came on March 27. So basically, this is due to large sell-off in the domestic equity and bond and forex market, liquidity premia on instruments such as corporate bond, commercial paper, and debentures. Their prices have surged due to COVID, and this all combined with thinning of trading activity, financial condition for the instrument which are used inter alia to access working capital in the face of slowdown required RBI to come up with TLTROs. RBI conducted auctions of almost 1 lakh crore of funds, and they have requested the banks to come for auction. One second, we have got a question. We will take it up after this thing. This is related to a job loss, and we would take it up at the end of the session. Now, liquidity availed under the scheme, which is 1,000 crore by each of the bank, has to be deployed in investment grade corporate bonds, commercial paper, and non convertible debentures over and above the outstanding of the investment as on March 27th. So therefore, if you see, RBI has brought in lot of liquidity in the market by infusing funds through TLTRO mechanics. The only requirement was that this has to be deployed by the banks in investment grade corporate bonds, commercial paper, and NCDs. Also, it is interesting to note that the up to 50% of these were were holdings of eligible instrument from primary market issuance, and remaining would be from the secondary market issuance, including mutual funds and non-banking finance companies. Also, there are certain whenever bank holds the funds, they have requirement of held to maturity as well, and RBI wisely stated that this all will be classified as held to maturity even if this is excess of 20% of held to maturity portfolio of each of the bank. In addition to that, one more measure RBI suggested to the bank is that whatever exposures under this facility bank would be taking, that would not be treated as large exposure framework. Now, I would just simply explain to you how it works. If suppose it's Reliance or Adani, any company, bank can hold only up to certain exposure. Now, when TLTRO is infused within the bank and bank would auction and get the money, now if the large credit exposure is going to exceed for a bank, even if Adani and Reliance or any other company having a good rating would not be able to subscribe their bonds or NCDs. Therefore, to overcome this problem, RBI also declared that large exposure framework would not be applicable for the banks in terms of money utilized under TLTRO. Now, TLTRO second round, which is TLTRO 2, came again in April 17th. The next next time RBI governor came and declared multiple measures, and one of them was TLTRO 2. And again, RBI declared that 50,000 crore would be infused within the market. Now, one important thing to note that while giving this 50,000 crore, RBI also included NBFCs. RBI also included NBFCs, and they have stated that all small and mid-sized NBFCs and MFI would be included into this. Now, next is cash reserve ratio. This is also some sort of measure RBI took in terms of liquidity management. Now, what is cash reserve ratio? Before we get into the RBI measure, the cash reserve ratio is of all banks by 100 basis points. So basically, cash reserve ratio is minimum fraction of the total deposit of customer, which the commercial bank, have to hold as a reserve, either in cash or as deposit with central bank. So therefore, RBI put in a condition to banks that some amount, fraction of the deposit which you and I as a customer put in the bank, they have to keep it in the as a reserve, either in cash or deposit with central bank. So if tomorrow there is sort of any sort of issue with the bank, at least the depositor would get back their money. Now, this would mean bank will have to necessarily keep the deposit with RBI from time to time. Now, to increase the liquidity in the market, RBI reduced the cash reserve ratio of all banks by 100 basis point to 3%, which in turn increased the liquidity in the market. And please note that this CRR balance maintenance, which has been reduced from 90 to 80%, is a one-time dispensation available up to June 26, 2020. Now, in addition to these two measures, RBI also came up with Marginal Standing Facility, which is MSF, on March 27, 2020. Under marginal standing facility, banks can borrow overnight at their discretion by dipping up to 2% into the SLR, which is called statutory liquidity ratio. RBI increased the limit of 2% to 3% with immediate effect on March 27. So thereby, what has happened due to this measure, banks can now borrow overnight at their discretion instead of 2%, 3%, which is a huge sum which can bank borrow and put it in the general market. Now, next measure was widening of monetary policy rate corridor, which also again came in March 27, 2020. Now, what has happened due to lockdown, consumption reduced and there is an excess liquidity. What is happening? We are not going out. The consumption of petrol, consumptions of all other materials have been reduced, and therefore the expenditure or spending of people has been reduced, and thereby people are not withdrawing the funds generally being withdrawn in a normal scenario, and hence there is excess liquidity in the banking system. Therefore, RBI decided to widen the existing policy rate corridor from 50 bps to 65 bps. And under the new corridor, the reverse repo rate under liquidity adjustment facility, which is called LAF, would be 40 bps lower than the policy repo rate. And the marginal standing facility rate would continue to be 20 bps above the policy repo rate. Now, what is reverse repo rate? It is the rate at which central bank of the country, which is in our case Reserve Bank, borrows money from commercial bank within the country. So if you see, since RBI has increased the reverse repo rate, thereby banks will be more keen to lend in the market rather than stocking. Now, in addition to these measures, RBI on April 17, 2020, declared that there would be refinancing facility for all India financial institution, which is called AIFIs. Now, RBI declared a special refinance facility for amount up to 50,000 crore to NABARD, SIDBI and NHB. Now, mind it, NABARD, SIDBI and NHB, they have limited resource of funding, but they are very critical in terms of our, our economy and to give loan to certain sections of borrower. And therefore, RBI decided to give this special refinance facility to them to enable to meet their sectoral credit needs because they work in a various sector, unless like general public sector. And then this 50,000 would comprise of 25,000 to NABARD for refinancing regional rural banks, cooperative banks, and microfinance institution. 15,000 crore to SIDBI for on lending and refinancing, and 10,000 crore to NHB for supporting housing finance companies. And advances under this facility will be charged at the RBI policy repo rate. Now, another measure which RBI came up with is ways and means advances for states. Now, what is ways and means advances? Now, this is a mechanism which is used by RBI under its credit policy to provide temporary loan facilities to various states. We have various states, and each state can take temporary loan from RBI in order to mitigate or tide over temporary cash flow mismatch in their receipts and payments. So on April 1st, 2020, RBI announced an increase in the ways and means advances for the states by 30%. And thereby, RBI now is giving and planning to give more and more funding to the states to fight this COVID menace. Now, the WML limit of states by 60% and above the level on March 2020 would provide a very greater comfort, as I have stated to you. And this would also plan the marketing, the borrowing programs better for the states. And please note that this increased limit will be available until September 30, 2020. Another measure taken by RBI is liquidity adjustment facility, which is fixed rate reverse repo. In order to encourage the bank to deploy the surplus funds in their system in investments and loan in productive sector of economy, RBI decided to reduce the fixed rate reverse repo rate under the liquidity adjustment facility by 25 basis point, and thereby the policy rate remains unchanged at 4.40%, and marginal standing facility rate and the bank rate remain unchanged 4.65%. By reducing this reverse repo rate, RBI actually requested and required the banks to put in more funds in the market. Another measure is special liquidity facility for mutual fund. Now, as we have been discussing about all these facilities, nowhere we have seen that mutual funds have been discussed. So on April 27th, RBI stated that to ease the liquidity pressure on mutual fund, they open a special liquidity facility for mutual fund of 50,000 crore. Now, fund available under this SLF mutual fund shall be used by bank exclusively for meeting the liquidity requirement of mutual funds by extending loans to the mutual fund and undertaking outright purchases and or repos against the collateral of investment grade corporate bonds, commercial paper, debenture certificate held by mutual funds. Thereby, what would happen by introducing this additional provision of 50,000 crore to the banks, the mutual fund sector would have much more ease. Now, lastly, in this slide, there is RBI also took on March 27, 2020 financial market measure. Now, banks are typically before March 27 was not permitted to operate under various non-deliverable forward market. Now, RBI decided in consultation with the government to permit banks in India which operate in IFSC, International Finance Service Center banking units, to participate in non-deliverable forward market with effect from June 1, 2020. And the banks can participate through their branches in India and their foreign branches and through their IBUs, which are located in IFSC. Arshi, next slide.
Sure.
Now, so till now we have discussed the liquidity measures and the financial market measures by RBI so far, and what you would see overall that RBI is as a nodal agency of the country and as as giving instruction to all the bank and making ensuring that there are enough liquidity in the market so that there is no disruption in the financial services sector and otherwise in the market. Now, coming to the regulatory measures, RBI being the regulator also bring in certain regulatory measures in the system. One of them is rescheduling of the payment. Now, when the lockdown happened, except for essential service provider, there have been various non-essential service providers, and we can see within our society and nearby, those have been closed just to stop the spread of COVID. Now, because of that, a lot of businesses suffered losses. They were not able to work at their optimum level, and thereby there was a risk of increasing default by the banks by those borrowers towards banks and financial institutions. So what happened? RBI on March 27 came up with rescheduling of payment of term loan and working capital in a statement, and which was followed by a notification on the same day. And thereby RBI directed all commercial banks, including regional rural banks, small finance bank, and local area banks, cooperative banks, and all India financial institution and NBFCs, including housing finance companies and microfinance, which you can see all the lending institutions, are permitted to grant a moratorium of 3 months on payment of all installment falling due between March 1 and May 31st. Now, this is very important measure RBI took so that there is no sort of exposure, there is no sort of, no sort of compulsion on the banks to call all the loans default in case the borrowers, due to COVID distress situation, fails to make payment of interest and repayment during this time, which is March 1 to May 31st. In addition to that, RBI also declared that working capital facilities sanctioned in the form of cash credit, overdraft, lending institutions are permitted to defer the recovery of interest applied in respect of all such facilities during the period from March 1 up to May 31st. Similar sort of treatment for working capital. Arshi, just put yourself on mute. The accumulated accrued interest shall be recovered immediately after the completion of this period. It is important to note that uh, this measure by RBI is a welcome change, but however, this all interest and principal repayment is getting accumulated and this is not getting extinguished, and at the end of COVID period, when we come out of this lockdown and when market will resume, it would be interesting to see that how RBI would come up with a new measure so that this moratorium either extended or the banks are able to recover the loan and borrowers are able to repay the loan and interest. Now, in addition to moratorium of this term loan as well as working capital, RBI also eased out the working capital financing requirement. Now, in respect of working capital facilities sanctioned in the form of CC, cash credit, and OD overdraft to the borrower facing stress on account of economic fallout of the pandemic, lending institutions have been instructed to recalculate the drawing power by reducing the margin and reassessing the working capital cycle. So what happens in working capital for the general public to know that every time, every year, there is a reassessment of working capital depending on the requirement and need of the borrower. By instructing the lenders to reassess and reduce the margin of working capital, RBI bring in the change and give a lot of comfort to the borrower on higher margin pressure. Now, this relief would be available up to May 31st, 2020. Again, the point is that we are already first week of May, and looks like that the lockdown has been increased for further 2 weeks, and once the business would resume with a lot of protection, it would be interesting to see that how RBI and the government would come up further to avoid this sort of ease out in the market. Now, in addition to that, RBI also declared and notified the classification of SMA, special mention account, and non-performing asset under RBI notification. Now, moratorium, deferment, and recalculation, what we have discussed just now, of the drawing power will not be treated as a concession and change in term and condition of the loan agreement. So what happens when borrower and lender enter into a loan agreement? They agree for certain terms in respect of interest payment. They agree on certain date to make repayment. Now, due to this COVID situation, RBI instructed the bank not to charge interest and not to take repayment from the borrower up to May 31st. Now, due to which there is a mismatch within the RBI circular which says if there is any sort of change, this would be treated as a default or non-performing asset in the book of the lender. Therefore, to remove this sort of inconsistency, RBI also clarified that the moratorium, deferment, and recalculation of drawing power given to the power given to the lender would not be treated as SMA or non-performing asset. This is a very important step to avoid default situation at least until May 31st. However, again, as I've been telling you, that it would be interesting to see that how RBI is going to come up after May 31st, and also interesting to note that these dispensations have not been provided for bonds and ECB market. Now we get a question from a viewer. Banks are charging interest on the 3 months moratorium. Yes, you are right. It's a very good question. And as I told you earlier, that there is no sort of extinguishment on loan or anything. And what RBI instructed the bank that each these sort of measures would be taken by the banks by their respective boards. Now, some banks, obviously, in lieu of deferring the repayment, they are charging some interest. Therefore, my suggestion would be to all of you is, in case if you have liquidity and you're getting your salaries, it would be better to pay your credit card bills, to your home loan, and not to go for this moratorium. I hope I'll be able to answer your question. Now, next is deferment of last tranche of capital conservation buffer, which came on March 27, 2020. Now, this capital conservation buffer is designed to ensure that banks build up capital buffer during normal times outside the period of stress, which can be drawn down as losses are incurred during a stress period. Now, this capital conservation buffer is something which has been discussed and deliberated in the Basel standards, and the CCB was to be implemented in tranches by RBI. Now, considering the potential stress on account of COVID, RBI decided to further defer the implementation of the last tranche of CCB, Capital Conservation Buffer, from March 31st to September 30. Now, in addition to this, RBI also came up with further regulatory measures on April 17, 2020. In respect of all, one is asset classification. Now, in respect of all accounts for which lending institution decided to grant moratorium or deferment and which were standard as on March 1, 2020, the 90-day NPA, which is non-performing asset norm, shall exclude the moratorium period. Thereby, what RBI actually put in place mechanics in the system is that till the time the moratorium is there, the NPA calculation will not will not take into effect. Now, while giving this sort of instruction, RBI was very much aware that this would build up the risk in the bank's balance sheet on account of firm level stress and delay in recoveries. So, to mitigate this thing, RBI also instructed that the banks will maintain higher provision of 10% on all such accounts under the standstill spread over 2 quarters. So, thereby, the accounts where there is a standstill in term of repayment of loan or interest, RBI decided and RBI instructed to the banks to maintain 10% higher provisioning. Now, again, this is something which will obviously reduce the liquidity for the banks. Reason being, in case the borrower and the lenders have no option, but lenders will have to give the moratorium, and if the borrowers decide to go for the moratorium, for each loan, the lenders will have to maintain 10% higher provisioning. Though this will reduce the of stress of default in the financial market, however, this may accumulate the NPAs at a later point of time. This is a short-term measure, and it is interesting again to see that how RBI would formulate after May 31st to continue this sort of moratorium period or to come up with some sort of new measures. Now, all along we have been discussing about the banks, the liquidity, the regulatory measures. So on April 17th, RBI also came up with another measure, which is NBFC loan to commercial real estate project. Now, what has happened due to COVID situation, all real estate project got affected, all the workers within that sector got affected, all the interested party got affected, including there are many NBFCs who have lent to those projects got affected. Now, what RBI decided to do for those loans, they decided to increase the date of commercial operation, which is DCCO, for an additional 1 year over and above the 1 year extension permitted under normal course for the banks, and the same thing was also extended for the loans given by NBFCs. Thereby, what happened? The NBFC loans are also not to be treated as NPA or stress asset, and thereby the NBFCs can also change the DCCO date with respect to the real estate projects. However, it is to note that this would be dependent on each NBFC deciding in their board how they're going to take it forward. Now, in addition to that, RBI also extended the resolution timeline. Now, under June 7 Prudential Framework of Resolution of Stress Asset, there is a timeline of 210 days to resolve the resolve any account which is stressed and come out with resolution plan. And to that extent, banks will have to make an additional provision of 20% if the resolution plan is not implemented within 210 days. What RBI did, RBI excluded this 90 days period during which moratorium and all other measures have been implemented from within that 200 days of counting of default. Thereby, RBI gave lot of relief to the stress account as well as to the lenders who were engaged in resolution for those accounts. And thereby, banks now don't have to maintain a provision of 20%. And this would increase the liquidity within the banking system. In addition, RBI also declared that the scheduled commercial bank and cooperative banks shall not make any further dividend payout from its profit pertaining to the financial year ended March 31st, 2020 until further instruction. And these restrictions shall be reviewed on the basis of financial positions of market for the quarter ending September 30, 2020. This also, in my view, could have been implemented for the NBFC sector as well, because as there is a lot of stress in NBFCs, RBI could also instruct NBFCs to not to declare dividend and keep it within their system. Now, in addition to this, there is liquidity coverage ratio, which has been put in place by RBI. The liquidity coverage ratio for all of you is the requirement whereby bank must hold an amount of high quality liquid asset that's enough to fund cash outflow for short term obligations. Now, in order to ease the liquidity position at a level of individual institution, the liquidity coverage ratio requirement for scheduled commercial bank now being brought down from 100% to 80% with an immediate effect on March 27. The requirement shall be gradually restored back in two phases, first 90% by October 1 and then 100% by April 1. So these are the measures taken by RBI so far in terms of bringing in liquidity in the market, restoring the financial strength, and also liquidity coverage from time to time. Now, these measures are though temporary, but these are very effective so far to stabilize the volatile situation in the financial market. And we expect that once business will resume, RBI will come up with more measures to revive the economic stress caused due to COVID. Now, let me see. We are done with the RBI part. I'm just checking if there are any questions which I can answer. Then we would go to the next slide, which is on SEBI. Now, one viewer has asked whether Vijay Mallya and big borrowers loan have been waived off. No, it has not been waived off. It, it is still there. I think one more question is, are the banks allowed to engage agents for collection of payments, because these third party agents are very annoying? Banks typically employ third party agents, but till now, due to lockdown, I don't think agents are going out in the market and collecting the payments. Now, next slide. We would go ahead. If viewers have any question, please feel free to put the questions, and I will take it up while going ahead with the presentation. Next one is on SEBI. Now, the security SEBI is Security Exchange Board of India, and it is the most important regulator for securities market in India as well as for listed company. It is the SEBI's objective is to protect the interest of investors in securities and promote and develop and regulate the securities market for matters connected therewith or incidental thereto. Now, the measures taken by SEBI is the following. So what happened? SEBI released a consultation paper on April 22nd, 2020 and invited public comments on pricing of preferential issue and exemption from open offer for acquisition in companies with stress asset. Now it is important to note that this is a very important chapter for companies who are interested in raising funding during this time, and one of the important measure SEBI came up is with respect to rights issue. Now, the Primary Market Advisory Committee of SEBI has identified three key issues. One is an objective criteria for determining a company as stressed, a reasonable pricing for preferential allotment, and exemption from open offer obligations. Now, we will go into all these details one by one. The Primary Market Advisory Committee also recommended that SEBI may seek public comments on the following recommendation for exemption in pricing of preferential allotment. Now, while releasing this consultation paper, SEBI specified that for a company or for an entity becoming a stress, any of the two of the following three conditions shall be considered, and these conditions are as follows. One, any listed company that has made disclosure of defaults on payment of interest, repayment of principal amount on loans from banks and financial institutions, and listed and unlisted debt securities for two consequent quarters in terms of SEBI circular dated November 21, 2019. Second, existence of integrated agreement in terms of June 7 circular, which is prudential framework of resolution of stress asset. And thirdly, downgrading of credit rating of listed instrument of company to D. So any of out of these three, if any of the entity is coming within the ambit of two conditions, that company or that entity would be treated as stressed. Once it is treated as considered as stress, the eligible exemptions would be the following. One, there would be a proposed exemption under ICDR, issue of capital and disclosure requirement regulation. Now, under ICDR, there is a calculation while you go for an issuance, there is a calculation, and shares cannot be listed less than either average of the weekly high and low volume weighted average price of 26 weeks or 2 weeks, whichever is higher. Now, it is obviously imperative that 26 weeks back, the company's shares would have been traded at a higher value, and 2 weeks back, it would have been traded at a lower value, and which would continue for some time. So, if a company would consider as stress, they don't have to comply with that 26 weeks preceding the relevant date compliance, and it would be just taken into 2 weeks preceding the relevant date. Another exemption given by SEBI is exemption from making an open offer may be considered for the allottees of preferential issue in the stress company if acquisition is beyond the limit prescribed in terms of regulation 3.31 of SAST regulation. Now, what does 331 says? No acquirer shall acquire shares or voting rights in target company, which taken together with shares or voting rights, if any, held by him or by person acting in concert with him in such target company, entitle them to exercise 25% or more of the voting right in such target company unless the acquirer makes a public announcement. So therefore, if there is a issue, and in that issue, if an acquirer is going to acquire more than 25%, it has to be an open offer. Now, listed companies complying with the condition mentioned there shall ensure that the following in order to avail the above mentioned exemption is there for stress company. One is the preference issue is made to the person entities that are not part of the promoter or promoter group on the date of board meeting to consider the preferential issue. So when there is a preference issue which is more than 25% and the exemptions taken by the stress asset company, they have to ensure that the promoter or promoter group is not part of that preference issue. Resolution, secondly, resolution for preferential issue at the aforesaid pricing and exemption from open offer must have been approved by the majority or minority shareholder. Proposed issue or proceed of such preferential issue will be disclosed in the explanatory statement sent for the purpose of shareholders' resolution, and a monitoring agency will be appointed for monitoring use or proceeds of such preferential issue. And lastly, the shares issued to the investor is in such an issue shall be locked in for a period of 3 years from the latest date of trading approval granted by all stock exchanges where the specified securities are listed. So once all these conditions are made, preferential issues can be done, and that is without open offer. Now, please note that this all the public at large has been asked to give comments by May 13, 2020. Now, next is relaxation from compliance of REIT and InvIT. Now, though some relaxations were given by SEBI by this circular dated March 23rd, 2020 to REITs and InvITs in terms of regulatory filing, but now it is not that important because the timeline was extended up to a period of March 31st, and which is already over. So therefore, the next is relaxation is in compliance with the requirement pertaining to mutual funds. Now, SEBI issued a circular dated March 23rd, 2020 in relation to relaxation in compliance with requirement pertaining to mutual fund, and the following measures were taken. All schemes where observation letter was issued by SEBI and yet to be launched shall have a validity period of 1 year from the date of SEBI letter, and all new scheme, which is called NFO, where final observation letter will be issued, shall have a validity period of 1 year from the date of SEBI letter. So you can see that SEBI has extended the timeline for NFOs. Further, extension of certain policy initiatives such as risk management framework for liquid and overnight funds and norms governing investment in short-term deposit, review of investment norms for mutual funds for investment in debt and money market instrument, and valuation of money market and debt securities. Further, the access control presently exercised by all mutual fund AMCs are basically called recording facilities and other facilities which are typically there. But due to this lockdown situation, this compliance have been temporarily relaxed, subject to checks and balances, including electronic confirmation by way of email and other system having audit trail are in place. So these are the important changes which and extensions given by SEBI in terms of mutual funds. Now, in addition to mutual funds, There has been extension of timelines for issuance and filing of issuers who have listed or proposed to list their non-convertible debentures, non-convertible redeemable preferential shares, and commercial papers. So on March 23rd, 2020, SEBI came up with a lot of extension with respect to this compliance requirement. First is cutoff date for issuance of NCD, NCRPS, and CPs, and that is now 60 days, which is now on or before May 31st. Second, there are compliances with respect to large corporate initial disclosure and annual disclosure, where also SEBI has extended 60 days and 45 days for compliances. Also, certain relaxations were given under the financial results disclosure, and extension of timelines also given for issuer of municipal debt securities. Now, in addition to this NCDs, non-convertible, redeemable preference shares, and commercial papers, there are certain relaxations were also given by SEBI with respect to issue of capital and disclosure requirement regulation 2018 in respect of public issues and right issues. Now, this is very important for the companies who are looking for raising funds. Now, on April 21, SEBI has declared certain relaxation with respect to eligibility condition related to fast track right issues. Now, mind it, these are all fast track right issues. What they what they did, they came up with certain temporary relaxation with respect to Regulation 99 of ICDR regulation, which is basically eligibility conditions, and they have extended the following things. One, in Regulation 99A, the word 3 years has been reduced to 18 months. So basically, the equity shares of the issuers have to be listed on any stock exchange for a period of at least 3 years immediately preceding the reference date of rights issue. Now this has been reduced to 18 months. Second, in Regulation 99C, the word 250 crores now shall be read as 100 crores. So therefore, the average market capitalization of public shareholding of the issuer now need not to be 250, it can be 100 crores. These are very important. Now, thirdly, 99F of the ICDR says that 3 years, there has to be at least period of 3 years. There has to be equity. The issuer shall have been in compliance with equity listing agreement or the SEBI listing obligation disclosure requirement 2015 as applicable, and now that period has been reduced to 18 months. Further, also SEBI has stated that in terms of no show cause promoter in cases where there are where against cases are against issuer or its promoter director companies, SEBI has also added that if there are no show cause notices, excluding under adjudication proceedings, which have been issued by the board and pending against the issuer or promoter or whole-time director as on the reference date, this would also be excluded. Now, next relaxation which SEBI came up is with respect of minimum subscription. Now, under the rights issue, the minimum subscription was earlier 90%, which has now brought down to 75%. Further relaxations are given by SEBI with respect to minimum threshold required for not filing draft letter of offer with SEBI, and now this is read 10 crores or more instead of 25 crores. Now again, these are temporary relaxations. These are applicable for the rights issues that are open on or before March 31st, 2021. So please note that this is available up to March 31st, 2021. Now, in addition to these measures, SEBI also relaxed the regulation 24(1)(f) of SEBI buyback of securities regulation, which is the current regulation. Buyback regulations provides a restriction that company shall not raise further capital for a period of 1 year from the expiry of buyback period, except in discharge of their subsisting obligations. It has been represented that the said period of 1 year may be reduced to 6 months, which would be in line with 68(8) of the Companies Act 2013. And this relaxation would be applicable till December 31st, 2020. Archie, if you can take up the other one. Next slide. Yeah.
Okay.
Regulatory
So,
measures by SEBI.
yeah, I'll briefly explain the regulatory measures which have been taken by SEBI. So, with the objective of ensuring orderly trading and settlement and effective risk management, these measures were taken by SEBI on 23rd March, and they were initially taken for a period of 1 month, but they now have been extended till 28th May 2020. For stocks in F&O, future and options segment, market-wide position limit may be revised up to 50% from the existing levels if the following criteria are met. The same being average daily price high-low variation percentage for the during the last 5 trades should be equal to or more than 15%, and the average market-wide position limit utilization percentage should be more than or equal to 40%. Now, for such stocks which meet the aforementioned criteria, the margin rate of cash market shall be increased to a minimum of 40%, as has been in a phased manner, as has been specified in the circular itself. For stocks with price band of 20% and witnessing an intraday price movement of more than 10% during for 3 or more days during the last 1 month, the minimum margin rate specified in the circular itself. Now, coming to the position limits in equity index derivatives, the mutual fund exposure to equity index derivatives or the client's holding of stocks.
I think there's some network problem with Arshi. Next is flexing of dynamic price band of F&O stocks, and which is one of the measure taken by SEBI. Uh, Now, these are the measures taken by SEBI from time to time to at least ensure that there is no market volatility, and as well as there is a system which should persist during the COVID scenario in the market. Now, next is measures after SEBI. The next point is measures taken by IBBI, which is the Insolvency and Bankruptcy Board of India, and the MCA, which is the Ministry of Corporate Affairs. Now, why these two are important? with respect to banking and finance, because IBBI deals with various regulation and implementation of insolvency and bankruptcy code, and it has been established as a nodal agency for that. And Ministry of Corporate Affairs is concerned with respect to administration of the Companies Act as well as other allied act and rules regulation framed thereunder. Now, from the viewers who are from company, it is very important that there are certain filings and certain other relaxations which were given by the MCA, and we will take you through that. But before that, we will discuss about the measures taken by Insolvency and Bankruptcy Board of India. Now, this is very important, and very important development took place during this time. Now, certain developments are on March 24, 2020, IBBI raised the threshold of default under Section 4 of the IBC, uh, Section 4 of IBC 2016 to 1 crore. So what has happened earlier, it was 1 lakh, and from 1 lakh they have extended this to 1 crore, which is almost 100%. Now, what is the impact? The impact is the lenders, operational creditors, as well as various other interested parties now would be severely impacted, because for a loan which is below 1 crore from after March 24, 2020, they will not be able to take any sort of action. Now, this would leave the creditor with very limited choice of enforcement, not various creditors. Also, it is important and pertinent to note that this measure was to safeguard the SME and MSME sector. However, now this is applicable to all others who may or may not be impacted on COVID. So there is no sort of uh, criteria. It is a general criteria basis which this threshold has been extended, and there is no sort of identification with respect to the affected party to whom this dispensation can be given, and this is overall has been extended to the whole market. Now, this might vitiate the purpose of implementing the IBC code, because by virtue, what is happening, the lenders and creditors, genuine creditors, they may not be able to take any action, and it might be a problematic scenario for the lenders to enforce, and thereby this would impact ease of doing business in India by the lenders as well as by the foreign promoters, or the lenders, foreign lenders. Also, it is important to note that RBI has already granted moratorium on the loans and interest. In addition to that, I think this step IBBI or government could have taken later on, not now. What would happen, therefore, default occurs post moratorium would be interesting to see. Now, in addition to that, on April 17, 2020, IBBI also notifies the exclusion period of lockdown under 47A, and basically what they have stated that the resolution timeline and in relation to timeline, that has been not to be reckoned with respect to the lockdown period. Now, this will provide interim relief to the resolution applicant and the creditor who are already formulating resolution plan during this time. And due to COVID situation, obviously the lender and resolution applicant and various companies who would be interested of coming into the resolution plan may not be able to conduct meetings, pass necessary authorizations which are critical for a successful implementation of resolution plan. Also, it is a welcome move because adjudicating authorities, which is NCLCs and NCLAT, they are not able to function 100% and their full strength, and therefore this exclusion period of lockdown would help immensely. However, please note that all these measures would also have impact on valuation of the asset, and also financial stress in the market would impact the resolution plan, because what is going to happen during this resolution plan, if valuation deteriorates, the lenders will not be able to recover the maximum value of the asset. Now, on top of it, there is a now last nail in the coffin, which is Union Cabinet clears a proposal to insert Section 10A in the code, and whereby, as per the proposal, this is going to suspend Section 7, 9, and 10 for 6 months or until further order, with a rider that amendment clause cannot be extended to more than a year. Now, the impact would be very huge, because the whole system, which is operational in with respect to resolving the defaulted cases, as well as building the comfort and building the confidence within the creditor group, would obviously get diminished, because effective enforcement would not be able to take place under the IBC during this time. Everything would be on standstill. Also, as I stated earlier, also this would have maybe a short-term impact on India's rating on ease of doing business, and lenders may have to opt for alternative options for enforcement of their security under SARFAESI, or filing a suit, or under June 7th circular, to resolve the issues in the stress asset. So this is kind of measures taken by IBBI, which in some quarter, obviously, the borrower and the stress resolution applicant and few other parties have welcomed it, but mostly this might impact the lender community. Now, next is the measures taken by MCA, and I would request Arshi to kindly take those.
All right. So, under the measures taken by the Ministry of Corporate Affairs, talking about the first one, under the Companies Act 2013, all the companies are required to keep annual general meeting within a period of 6 months. And in case of the first annual general meeting, the meeting is supposed to be held within a period of 9 months. Now, this requirement has been relaxed by the MCA for all the companies whose financial years have ended on 31st December 2019, and it has been provided that the annual general meetings can be held within a period of 9 months, which effectively makes the last date to be 30th September 2020. Considering the difficulties which the companies are facing in conducting the board meetings, the Ministry of Corporate Affairs has held that such meetings can be held through video conferencing or other audio-visual means under Rule 3 of Companies Meetings of Boards and its Powers Amendment Rules 2020. Board meetings under Companies Act under Section 173 of the Companies Act are supposed to be held within a period of 120 days. Now, the Ministry of Corporate Affairs has provided an additional 60 days under which these board meetings can be held, and which makes the total number of effective dates under this case to be 180 days. No additional fees shall be charged for late filings during moratorium period starting from April 1st, 2020 till 30th September 2020, before the MCA 21 registry, in case of any late filings of documents or returns or statements, etc., irrespective of any due dates. Now, the Ministry of Corporate Affairs came out with the Companies Auditors Report Order 2020, and under this, in short, which is known as CARO 2020, this is applicable for audit of financial statements of eligible companies for the financial year starting or commencing on or after 1st April 2019. Now, the Ministry of Corporate Affairs has provided another relaxation in which it has been held that the CARO 2020 will be applicable from the financial year 2020 to 2021. This in turn will ease out the burdens on the companies and the auditors for the financial year 2019 to 2020. Now, under Para 7 of Schedule 4 of the Companies Act 2013, the independent directors are required to hold a meeting amongst themselves without the involvement of non-independent directors and the members of the management. This requirement has now been relaxed by the MCA, although it has been suggested that the independent directors may share their views via other different modes of communication, the same being telephonic conversations or via emails, if they deem it to be necessary. Newly incorporated companies are required to file a declaration of commencement of business within a period of 180 days. Now an additional period of 180 days has been provided by the Ministry of Corporate Affairs to file such declaration. Non-compliance of minimum residency in India for a period of at least 182 days by at least one director of every company has now been relaxed, and the same will not be considered as a violation if this will not be followed. The same is a requirement under Section 149 of the Companies Act. Now, there is a requirement to create deposit repayment reserves of 20% of deposits maturing before 30th April 2020, and there's another requirement to invest or deposit 15% of the amount of debentures maturing before 30th April 2020. Now, this deadline has again been extended, and the deadline has been made as 30th June 2020. Now, there is another circular talking about the clarifications of passing of ordinary and special resolutions passing of ordinary and special resolutions by companies. Under this also, it has been provided that the companies which have and the companies which do not have the facility of e-voting will the companies which have and which do not have the facility of e-voting will issue the notices to all the members via emails to the registered via emails which are registered with the companies or the depositories participate. Now, under the CSR expenditure, the MCA has made various clarifications that the expenditures made to the PM Relief Fund will be considered as a CSR expenditure. On the other hand, the expenditures made to the CM Relief Fund or State Relief Fund for COVID-19 will not be. Lastly,
so just to add this, sorry, there has been a lot of hue and cry because of this, because there are various state relief funds and states are also working during this COVID time. However, since this exclusion is there, there has been a lot of hue and cry, and there are a lot of fights happening between the states as well as the center. Please go ahead, Ashi, quickly.
Okay. So, lastly, talking about Form CAR, the MCA came up with Form CAR in order to assess the readiness of the companies to deal with the COVID-19 threat.
Okay. Now, these are the important provisions we have now covered: RBI, SEBI, as well as IBBI and MCA. Now we are going to get into an interesting two more slides, which is one is with respect to FEMA, Foreign Exchange Management Act, and lastly the general issue which are lender and all other borrower and other people are facing in the lending and borrowing transaction. So I will quickly take you through the FEMA provisions. There has been a relaxation from compliance with respect to for FEMA this thing, and basically DPIIT has issued various relaxation basis the representation given by Company Secretaries Association, and those relaxations are basically to reduce the compliance requirement. Now, in addition to that, the most important part, and which is mostly deliberated, and it is coming in various media and news, is that uh, Government of India, Department of Promotion and Industry and Internal Trade issued a press note on April 18, and subsequently on April 22 amended para 311 of the FDI policy, whereby they have stated that any non-resident entity can invest in India subject to FDI policy except in those sector and activity which are prohibited. However, an entity of a country which shares the land border with India, or where the beneficial owner of an investment into India is situated or is a citizen of any country, can invest only under government route. Now, this is basically, we share border with Pakistan, Bangladesh, Sri Lanka, Nepal, Bhutan, and China, Myanmar as well. Now, this is actually as per this circle, as per this para and policy. This is just to stop Chinese investment, as well as basically to regulate the Chinese investment in future. Now, also one more provisions they came up, that in the event there is any transfer of ownership of any existing or future FDI in any entity in India, directly or indirectly, which result into in the beneficial ownership falling within the restriction and purview of para 3.1.1a, such subsequent change in beneficial ownership will also require government approval. Now, in addition to these things, Ministry of Finance on April 22, 2020 amended the rules further to amend the foreign exchange management non-debt instrument, and which are also in line with the same thing, to stop the investment with any entity which shares the border with India. Now, what are the impacts? Which is very important to understand the impact. Basically, this is going to impact the Chinese investments, and they would be under scanner and now henceforth require government approval. Now, one more interesting fact is that while these provisions have been shared by relevant ministry and relevant board, but they have not defined the beneficial owner and beneficial ownership, and this beneficial owner and beneficial ownership are actually defined in Companies Act and RBI KYC master direction. However, there could be interpretational issue, because the beneficial ownership and beneficial owner is defined. This Companies Act and RBI are different legislation. Also, it is interesting to note that direct or indirect will also create different degree of uncertainty, that how direct and indirect will be taken into account. This is also important. This is not only investment, this also the restriction on transfer of ownership, which will impact the exit of financial investors. So thereby, because of this measures, this would impact the fundraising activities by the startups companies that already have Chinese investors on board. Also, it is important to note that the approvals, which are the existing approvals, sometimes those approvals would have one-time dispensation to avail up to 50 billion. Now, what is going to happen with the remaining funds which are not yet availed under the existing approval? It is interesting to see. In addition to that, though these avenues are blocked, or these avenues are subject to government approval, FPI route is still active, but with sealing, FPI licenses allow funds to freely invest up to 10% of the share capital of Indian company, and thereby Chinese investors and other investors who are restricted by by direct investment under FDI rules and regulation, they can still use FPI route, but that would not be sufficient because that would be limited to 10%. And in addition to FPI, NRI, PIS, Alternative Investment Fund, AIF, InvIT, and REITs are still available for them to invest in. Now, the last slide, which is and the last topic, which is impact on lending and financial transaction. Now, what are the impact on lending and financial transaction? We will discuss that. Basically, the impact is multifold. One is that the lenders can call it a material adverse effect. Typically, in all lending documents, there are material adverse effect clause, and which says that if there are any sort of substantial change or impact on the loans granted by the lender to the borrower, then the lender can call it a material adverse effect, thereby call it an event of default. Due to COVID situation, obviously there has been a lot of business as well as financial impact on a lot of companies who have already entered into existing loan agreement with the lenders. Though there has been dispensation given by RBI, SEBI, and under FEMA and IBBI, we think that the contractual there would be an issue by lenders calling it a default and taking the borrower to the court. Also, companies now will have to be very careful when they are planning to enter into various borrowing and lending transaction about their representation and warranties as well as financial covenant going forward. Also, it is important to note that COVID-19 would be considered as a force majeure event, and a party can call or terminate a contract due to a force majeure event in terms of section 32 on ground of frustration of or on ground of frustration of contract under 56. Please note that FM force majeure, which is FM, can be used by both parties, but frustration may be by one party. Also, it is important to note that due to this lockdown scenario, there has been a lot of disruption in terms of execution of documents, and there has been new and innovative methods have been taken or adopted by the borrower and lenders in order to execute the document digitally or electronically. And we see there would be a lot of changes going to come in future to make and ease the process of documentation with respect to lending transaction, including payment of stamp duty. Also, there has been issues in terms of regulatory filings, which we have discussed on the MCA related thing, and MCA has given a lot of dispensation. And in addition to that, we see there would be a litigation, rise of litigation in terms of MAE clause, force majeure, as well as frustration of contract. But it is interesting to note that all these would be dependent on the terms and conditions of the contract, and you may have to look into the contracts very carefully before invoking any force majeure or frustration of contract provisions, and you need to consult with the appropriate person. Now, in addition to this, central government declared banking industry as a public utility service, thereby bringing the banking services under the provision of the under the provision whereby no strikes by the employees or officer during the operation of law would be possible, and thereby banking industry will have to act continuously as a public utility service. And also we have seen there has been a few states who have relaxed in payment of stamp duty and registration of document, and going forward we expect that other states would follow the course. We are done with this. We would love to have questions from others. from the audience, and we would love to have their feedback as well. And in the event you have any questions further after this session, you can connect with us and we would be happy to provide you the answers. I thank all of you to take out time for our presentation, and I hope that uh, you have uh, got some idea that how from background RBI, SEBI, and various nodal agencies have been acting actively to keep the market active and running, and due to which, while many of us sitting at home have been get the banking business at our doorstep, and we are able to have a comfortable, at least near comfortable life due to this lockdown situation. Thank you.
Thank you.